Let's now begin an in-depth discussion with experts from around the world. Now, oil prices have fallen sharply for 4 straight weeks now, slumping by more than 60% since the turn of 2020. As the coronavirus pandemic continues to severely disrupt business, travel and daily life, demand for crude has been plunging. And major producers like Russia and Saudi Arabia haven't helped with the situation by launching an intense price war. This is stirring even more volatility in global stock markets as the world economy reels from the coronavirus pandemic. It's certainly a time of uncertainty, but to provide us with a better sense of what might lie ahead, we're joined by Dr. Kang, Head of Analytics Asia at S&P Global Platts, and Tony Nash, CEO and founder of Complete Intelligence. Let's first talk about the losses we saw on Wall Street on Monday. That will be overnight here in East Asia. First of all, Dr. Wu, starting with you. US stocks ended in the red again after while the talk of a $2 trillion coronavirus support plan, it actually failed to pass the Senate for the second time on Monday afternoon. And stocks have been extremely volatile in recent weeks, despite the Fed having cut its interest rates twice and rolling out other never-seen-before measures. So why have these moves failed to reassure investors? And are you expecting markets to fall even further?
This is a very volatile time, and overall the demand globally on commodities, on the economy is very weak. So it's kind of panic situation for many economies. It's really up to the individual governments to stimulate economy and global organizations. I do see that the current downward pressure on the economy and the commodity market will continue until we have a solution. However, the governments of the U.S. and other countries and the Fed could help the situation.
So investors need more signs of reassurance from the US government and possibly European governments as well. Well, amid all this, oil prices have also been getting battered day after day due to lower demand and this oil price war between Saudi Arabia and Russia. So, Mr. Nash, Moscow actually started this price war by refusing to agree to cut its oil production. It does seem like a rather risky game of chicken. So what are they actually aiming to gain from this brinkmanship?
I think they're just aiming for more say in the trajectory for crude. This is really a capacity game. Russia doesn't have the additional capacity available really to go to the mat against Saudi Arabia. Saudi Arabia has a lot of capacity available. So if Saudi Arabia wants, they can continue producing more volume. The problem is neither government can afford to produce at these rates. They both, for their fiscal health, not the cost of getting crude out of the ground, but actually their government fiscal health, they need crude prices about $20 higher than they are right now. So we don't see this as viable for either government for much longer.
So you think both countries, they might not possibly be able to afford this war basically in the long run? Well,
that's right.
Dr. Wu, what about you? You were actually in charge of research at King Abdullah Petroleum Studies and Research Center in Riyadh. What do you think MBS's strategy is?
I agree that there is the issue with the fiscal budget for Saudi Arabia. And similarly, there is the issue of the budget for Russia. However, in terms of how long they can sustain the current low prices, it also depends on how their physical and the kind of the cash sort of reserves they have. Saudi Arabia oil is very important. It's the MBS, the Crown Prince, has been trying to very hard to diversify the economy of Saudi Arabia. So currently, the overall oil market in turmoil, in a way that they have not very many strategies to pursue. One is to preserve the prices, and the other one is to preserve the market share or drive out the competitors. So it seemed that after 3.5 years of trying on the price defense, now they are turning to another strategy to drive out the competition in the oil market.
So Saudi Arabia trying to set itself as the market leader, basically. Well, with the impact of COVID-19 on markets and economies around the world, what dangers lurk around the corner if this oil price fall rages on for a prolonged period of time? Dr. Wu, do you think it could possibly be a potential nail in the coffin for many oil companies who are already struggling to turn a profit when oil was $40 a barrel, let alone $20?
Yeah, indeed, many companies, many players will get hurt. Other OPEC producers and exporters, smaller ones other than Russia, which is a non-OPEC, and Saudi Arabia, they get hurt. And globally, US shale producers and Canadian heavy and oil sands project operators, if the oil price, low oil price continues, is once the global the oil storage is running to the limit, then there's no choice. Some have to give up. Some have to reduce the production, and that will start from the high cost producers around the world.
Right, and the major producers do need to come together and agree to cut production, basically, for it to stabilize. But, well, actually, Mr. Nash, some say that the motivation behind this price war is to hurt the US shale gas producers. Do you agree with this view, and do you think it would actually work?
I think it might be. I think when we saw in 2015, we saw OPEC really take that aggressive stance against shale producers. I think it failed because U.S. authorities tried to, and very effectively extended credit to shale producers. I think this time that those same or even more aggressive instruments will be put in place to defend shale producers. That's not to say everyone is going to be healthy. That's not to say there won't be consolidation in shale. It's also not to say there won't be kind of close downs in places that are really expensive, like Colorado and other places to produce. But I think in general, the aim is to ensure that the volume of shale production in the U.S. stays relatively consistent, and that the U.S. can continue to be a net producer of crude, and I think that's really what the U.S. is focused on. Well, so I see this as a Saudi-Russia issue, and perhaps a Saudi-Iran issue as much as it is a kind of Saudi-Russia shale issue.
Well, as an aftermath of this price war, what do you think the long-term impact would be on oil markets, on oil companies across the world?
Well, I think crude companies have to become much more efficient. And this is really, there's a lot of automation, there's a lot of other things that can happen within oil companies. I think there's a difference between national oil companies and independent oil companies. So the national oil companies, typically pretty inefficient, and they'll probably stay that way. The independent oil companies, really the private sector ones, will have to get even more competitive, which there's plenty of room for them to get competitive, and I think they'll be the healthier ones in the long run.
So in the long run, it could lead to more streamlining of business and higher efficiency if all goes well, I suppose. But Dr. Wu, well, at the end of the month, the OPEC's current production cut deal will be expiring. So after that, what do you see on the horizon? Do you see prices dropping even further after that?
Yes, I do. The end of the month, I do not see that Russia and Saudi Arabia will come back to the negotiation table very soon. Eventually, they might, but not in the very short term. So April is probably one of the pretty challenging months for the oil market as the demand continues to drop due to the pandemic of the coronavirus, and oil production, not only the price formulas by the Saudi Arabia, but physical supply of OPEC, particularly Saudi Arabia, UAE, will increase. That will put a lot of pressure on non-OPEC producers, which are more dominated by independent in North America. Of course, also national oil companies as well. At the end of the day, the market needs to be balanced. so that the way to balance, the buyer can, Asia players include can buy more oil, but up to the limit of the storage, up to the limit of the current state of demand, which is very, very weak. So in that case, at the end of the day, some production has to cut and has to come from somewhere. But April is very challenging.
Well, what do you think, Mr. Nash? Do you think there'll be another oil cut deal?
It's possible. What we're seeing is we think the last half of April we'll actually see prices return. We think toward the end of April we'll start to see prices back in the 40s. So things may get slightly worse in the short term, and anything is possible. But within the 40s, crude prices are depressed anyway. We've started to see Asia really come back online post-corona, and we'll see that kind of move westward as well. So that consumption capacity, as that comes back online, that will put pressure on prices. The pressure between the Saudi government and the Russian government, their fiscal revenues, there will be serious pressure there. And you can bet there's probably pressure from the US government on the Saudis and the Russians to resolve this. So I think that pressure will only intensify over the next 2 weeks, and we'll see some resolution, say mid-Feb or mid-April or third week of April, something like that.
So you're expecting and hoping that this conflict between Saudi Arabia and Russia will be rather short-lived, and soon the oil market will stabilize. Well, that's all we have time for, I'm afraid. But thank you very much for joining the program today, Dr. Kang, Head of Analytics Asia at S&P Global Platts, and Tony Nash, CEO and founder of Complete Intelligence.
Thank you.
This is also where we end our show today, but we'll be back at the same time tomorrow with more insights from global experts. Until then, have a lovely day or evening wherever you are. Goodbye.